another FedEx delivery person?
Yeah, it was, well, it was a delivery. I don't know why I don't just put like the don't ring the doorbell sign on the front door, because I think I would figure that out 16 months into being in this house. But yeah, he's very aggressive.
You should have seen the guy trying to throw Rob out of his perch there.
So drug sniffing dogs are rich. You missed the pregame while I was sitting here minding my own business, and a unmarked white van pulled up behind me and challenged me. And I said, I'm just filming this nationwide show. And he's like, well, my boss owns those apartments that you're filming in front of.
And he's an attorney.
Which my knees started to shake and my lower lip started to tremble. So I think he sensed fear and backed off a little bit. And I said, I just want this dance studio in the background. And I wanted in the background, by the way, Rich, I'm in the Chicagoland area, but I wanted in the background. I was actually looking, Jeff, you'll be interested to know somewhat. I was looking for something to film that had a help wanted sign in the back or in the window, so in the background, but I couldn't find any help wanted signs. And it seems like just a few months ago, there were help wanted signs everywhere. And now,
times they are changing.
What's that?
Times they are changing.
They are changing. And so instead I found this dance studio, which if you think about if and when a recession does come, whether it's light recession or a hard recession, it'll be small businesses like dance studio owners that are negatively impacted because people may not want to send their kids to dance school, or adults may not want to learn how to ballroom dance. So it'll definitely be interesting as it always is, to see where the economy goes from here. But yeah, I've got the dance studio in the background here.
You're like a real on the street correspondent. I applaud your dedication to the show. Our podcast listeners, once again, missing out the hilarity of the live audiences, live showing as Rob is stationed outside what looks like a dilapidated dance studio, I guess, in the middle of the night.
This is somebody's dream, right? This dance studio owner had a dream to have this dance studio, and you'd hate to see small businesses crumble.
You tell the owner when he was giving you a hard time about filming, this was the most watched show in the mortgage industry? It was a very low bar.
Yeah. I left that little detail off. It was the gun waving. That's right. I'm in the Chicago area, so I didn't mention that.
Happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the rundown with Rob and Rich, where we take you into the weekend by running through the week that was in the mortgage industry. And you just never know how this show, I don't even know how this show is going to start off every week. So Rob's secret location, usually playing into the early script of the show. But this week, really pleased to have a good friend of TMC, good longtime friend of TMC, with recruiting being obviously such a top of mind issue, as well as data. We're always talking about data on this show. I wanted to get our good friend Jeff Walton from InGenius in to discuss that part of our industry, which is emerging right now. And Jeff, InGenius, also, you guys are doing something for our members. I heard from a member that they were fired up about revenue neutral special for our members to help get better data as it relates to making good decisions on hiring and other business development efforts.
Definitely. So good to be back. Good to see you guys as always. Excited about TMC coming up. I'm in San Diego at the NAREP convention. Beautiful view of San Diego out my window here, but if I open it, it turns into bright light and don't look into the light type of atmosphere. So we'll avoid that. But
hey, Jeff, that's never bothered Rich once on this entire series of shows.
Okay.
Having the light background, he just shrugs it off and moves forward.
Well, it kind of shades his face and helps everybody out. But so, so we've got that coming up, and we know that it's tougher times. People are trying to recruit. We don't care where you're getting your data from in order to recruit originators or build realtor relationships. We're looking at doing a revenue neutral. We feel that we've got better data than anybody in the industry. We get that confirmed by now 17 members of TMC that are customers out of our 38 or so that we've gotten in the last year and a half that we've been in business. And so we feel we can replace data that you have currently for recruiting with higher quality data at a revenue neutral cost to you. That's a win-win for everybody. And so we're excited about that. And we're getting really good reception on it. And we're excited about doing more with TMC for sure.
So Jeff, what is that? Explain to the non-accountants, which would include me. When you say revenue neutral, what does that mean?
Sure. So, let's say you're getting data today at a certain dollar amount, right, that you have a contract for. We're going to replace your instance that you have today, but it won't cost you any more money for that on an ongoing basis, so that you can increase the accuracy of your data and you can increase the applicability of that data by coming with InGenius. And it's not going to be an increase in outflow from your budget, which is very important in today's world, right? Obviously.
So if somebody, without saying anything too bad about your competitors or competitive sources, does it vary widely in terms of the information source, the cost to pay to get that information?
Yeah, so a good example of that is that we know we pay more for our data than our competitors do. And we know that because the way we put our data together is we don't just take one source of deed data. We take 3 different sources of deed data and we combine that, filter it, and sequence it with NMLS, MLS, HMDA, and then we bounce it all off of each other, all right, so that it fills in the gaps and makes it way more accurate. And then we take that data and we put it with contact data for loan officers and contact data for realtors, and then allow you to integrate that into your CRM. And then you can action off of those analytics and you can start to recruit and prospect realtors at scale. So we know that we pay a lot more for that data, and it provides higher quality data based on our patent pending process for doing that. But we also know that it's tough times. And we know people need this data though, because they need to grow in some fashion.
So if I were a small mortgage banker or a broker, at what level does it start to make sense to use this product?
Well, it doesn't matter how big or how small you are. We sell by number of seats, right? So if you're a smaller institution, you can still get access. So as we like to say, if in the past that if you're an institution that is buying several sources of data yourself, and you've got a data team that slices and dices and tries to put that together and load it into your CRM, we automate that entire process, right? So if you're doing that, you can save costs with us. If you're not doing it because you can't afford it, now you can, right? So we've made it affordable for the smaller and the larger, and we'll grow with you.
That's interesting.
Awesome. So many more lenders using data to make hiring decisions, using real data and not stuff that you could just try to find yourself out there. We're seeing the impact of it. And InGenius has been a big part of that. So Jeff, really, really appreciate the partnership and looking forward to the conversation. You brought some great stats that I can't wait to get into. Prompted me to dig up some industry stats as well. Just off of CFPB recently released all the HMDA data for 21, and I parsed through there. Got some interesting stuff we'll talk about as well. So let's go ahead and get into it. On the eve of TMC Chicago, tomorrow we begin what will be I don't think our biggest. We're like 20 people short of our last one, but the most lender members ever at a TMC conference, which I think really says a lot about our organization, given the climate right now. Very, very easy to cancel travel plans, but really looking forward to seeing 400, 450 of our closest friends these next few days in Chicago, and including my two co-hosts today. So
That's awesome.
Rob, the Fed, we keep leading with the Fed because it is the narrative that is really driving everything with our industry right now. Fed meeting this week, Tuesday, Wednesday, announcement Wednesday. No surprises, really. 75 bips. I think there was like a 14% chance of a 100 basis point move priced into the Fed fund futures market. So it was as expected. The rhetoric and narrative from Powell was really as expected. And then we saw bonds actually rally a little Wednesday afternoon, and then just all hell has broke loose the last 2 days in digging into this and trying to, there's no definitive reason why bonds should have sold off so much, pushing mortgage rates up even higher, pretty much 7% on a 30-year fix right now. And if you look, it is really, from what I can decipher in the UK, they not only sold a ton of bonds in the middle of the week, Wednesday, Thursday, but they also announced like a new budget essentially for their central bank that includes less bond buying. So, I think the moves in the UK, coupled with just this fear factor, people don't want to be wrong, they want to be left holding the bag, really has led to just really runaway train in the fixed income and in mortgage bond markets. Your thoughts on the transgressions of the week?
So you kind of summed it up nicely there toward the end. It's almost as if inflation was not the issue this week, although the Fed did as it was expected, and then the smartest people in the room immediately started talking about what's next and where we're going to be toward the end of the year and early next year. And this is just viewed as a stepping stone toward higher overnight rates and higher discount rates. The news from overseas regarding the UK and the bond buying and so forth, the thing I think that people on the call here need to remember is that, once again, the Fed doesn't set mortgage rates, but the same factors that influence the Federal Reserve Open Market Committee in its decision making influence mortgage rates. And so we've been talking about inflation for months and months now, and the Fed is definitely playing catch up. I think Fed Chair Powell admits that. But the thinking is now, if mortgage rates aren't set by the Fed and instead they're set by supply and demand, obviously the supply is down. You can look at the MBA application data nearly every week for the last several months. It continues to go down. And when I talk to originators all the way up to CEOs, it's very tough out there. And I think it's going to get tougher given that we're heading into the autumn and the winter, and with no prospect really of lower rates per se. And so a lot of lenders are out there really nervous about the next 3 to 6 months. So you have a situation though where mortgage rates are determined by supply and demand, and the new supply is down. But the question is, is the Fed going to start selling their mortgage-backed security holdings? And if, and when and how much, kind of thing. And so if they do indeed do that, I think as we're seeing in the UK, that tends to push prices down, rates up. And so the discussion over the last few days isn't so much where's inflation, where's the CPI, where's the producer price index. It's, what's going on overseas? Is there selling that's going to take place that's impacting mortgage-backed prices, and where does that take us? And so there is a lot of nervousness. I remind people that generally speaking, during a recession, rates go down, right? Rates go down, and they aren't going down. So the question is, why not? And it's a expectation of higher rates rather than the impact on the economy now, because whether it's the stock market or the bond market, those markets tend to be forward looking. They like to think that they can predict the future, which is a whole different breakout session. But the fact is the market is looking at what the Fed is reacting to and where they expect things to go from here. And we might be coming up on a recession, but nonetheless, if if institutions start selling bonds, it's a real problem for prices and therefore rates. So you're right, Rich. I mean, everybody knows rates have gone up. They've gone up overnight. They've gone up during the day, and 30-year mortgage rates are at whatever year high they are. And the 10-year yield is, we're now talking about a 4% yield on the 10-year, which I think just a year or two ago, wasn't it? It was about a 0.5% yield.
Yeah.
And very interesting situation. It's very leading to a lot of interesting discussions and observations about what banks are doing about it, what credit card companies are doing about it, what individuals are doing about it in terms of their own credit profiles and paying off their credit cards on time and so forth. So it's not a great situation by any stretch of the imagination. And I'll wrap up with we were talking to Mark Zandi recently. I think a fair amount of this is psychological, just like every market move is. And you can get into a self-fulfilling prophecy to some extent, because if I'm nervous, if the dance studio owner of this building behind me gets nervous, we all start cutting back our spending. We spend less coming up in the holidays, and that further compounds the problem. So, as always, it's an interesting situation and not a great situation for a lot of lenders out there staring at autumn and winter coming at them.
It's tough. No way to sugarcoat it. Been a tough year. Like you said, fall just starting. And then we're seeing just stats and data in our industry on market share and the biggest lenders in America, picking up more market share. Something that Jeff sent over some great data we're going to talk about in a second here. But it prompted me to really read through the CFPB and FHA are ever since they expanded the scope of the HMDA data they're collecting, they're putting out a lot of really relevant data about the mortgage industry, and just did a pretty expansive report a couple of weeks ago just on values and the statistics on who's doing loans and how many institutions are doing it. And I think what we've seen, Jeff, is the largest lenders are continuing to grow market share. That is why we started the Mortgage Collaborative right there. I think that the owners of this company in 07 and 08 saw the beginning and seedlings of a climate that made it very tough for small players to compete due to regulatory costs and other broad brush legislation. It's why this company was started. And, as we look at the landscape now, it's been a tough year for small lenders. Some made lots of money last couple of years and were smart with it. Some not as much. But nevertheless, here we are. And, it does look like a challenging landscape looking forward. And Jeff, why don't you start by talking just a little bit about some of the data you sent over, because it was really revealing.
Yeah, sure. So it's very revealing. And what our data shows is that currently the top 10% of the originators out there that do more than one loan are doing 56.57% of all loans in the marketplace since 2018. The top 30% are doing 88.29%, and the top 50% are doing 97.33%, right? Staggering numbers in terms of that. But what is also behind that is even more interesting, maybe not more interesting, but as interesting, is that over time, over the last 3 years, we've seen that number grow to where the top producers are doing more loans and the bottom producers are doing less loans. And I think that you're absolutely right, Rich, in terms of, the value of TMC banding together so that you can help the members engage with better technology. Because I think that, a lot of it is these originators taking advantage of technology, of using marketing technology and data technology and all these different, these different items out there. And to be able to give them access and knowledge to that, I think is a huge win for the members of TMC. And so to quote a famous philosopher, Sue Woodard, she's a philosopher now. I'm giving her that distinction. So it's not technology that's going to replace loan officers. It's the loan officers that are using technology are the ones that are going to replace the ones that don't, right? And it is highly important that you engage with the tools and the technology that is out there in order to compete in the marketplace. And I think that's what it tells us.
Very well said. I agree completely. And Rob, Jeff mentioned the stats and the top quarter, essentially percentage wise of lenders in America. If you go to dig even deeper, I took a look at the CFPB data. The top 25 individual lenders in America in 2018 did 33% of the units. In 2021, 44% of the units. So an 11% increase just from the top 25 lenders in America, not even, going, Jeff took his analysis a little bit deeper. Then you got the two biggest software companies in the mortgage industry, that are, trying to merge, that's getting looked at. It's a really interesting time for the mortgage industry. There have been industries where it has been to the benefit of the consumer and most people involved for industries to consolidate and larger providers because they can bring a lower cost product to customers. But if you look at mortgage, it's not that way at all. Fannie and Freddie buy 70% of the loans. Everybody's basically getting the same price. So ABC Mortgage in Twinsburg and, Wells Fargo, they're essentially selling to Fannie and Freddie for the same price. Smaller lenders have, in many cases, lower cost structures, ability to pass on lower prices. So this is an industry where customers clearly benefit from options and choices, and lots of them, and small lenders' biggest purchase of their lives. At what point do you think this starts to get it probably already has the attention of the federal government? I say it all the time. When anything the CFPB puts out, read the narrative that goes into the stats, because it tells you what they're looking at. And the narrative on their latest statistics were all about top tier market share lenders, and then obviously minority lending and what lenders are doing, what percentages of that business as well. So,
yeah, and I think to a certain degree, the pressure on small independent mortgage banks is going to increase in the regulatory side of things. In that we were just at NAMBA last week and saw the Associate Director of Enforcement and Fair Lending for the CFPB speak, and he is talking about looking at digital redlining and Community Reinvestment Act into low to moderate income census tracts and zip codes, and using that minority census tract, easy for you to say, Rich, and using that as a measuring stick as to, are you digitally redlining is the term. And his statement was, we don't care the size of the independent mortgage bank. We're going to be looking at all of them. And I think that's something to be taken, seriously.
Yeah, I'm fortunate to be up on the stage Monday with Mark McCarl from the CFPB in one of the breakout discussion rooms. I think that's definitely one of the things we're going to talk about. But Jeff, I wanted to ask you along those lines, and Rich, I don't, if you go back historically, there were always these huge, market share giants, used to be Countrywide, Wells, Washington Mutual or whatever, and things ebb and flow. And it's easy to go back 5 or 10 years, and most of those top 25 lenders are gone, or a good portion of them are gone or have been bought or whatever. I wanted to ask Jeff, when you talk about the loan officer focus and concentrations and so forth, one of the questions that I'm receiving often now is, gosh, margins, revenue, volume, it's all down, and the companies have had to bite the bullet in terms of the layoffs, in terms of overhead, in terms of they can't add money to their coffers because they're trying to stay ahead of the money losing curve. At the branch level, the same thing is happening. How do these branches maintain profitability and so forth? And so I'm being asked, when do you think loan officers will finally be asked to reduce their point or point and a half comp, because like I said, the companies have done it, the branches have done it. And now, what about the Rich and Rob loan officers who are still expecting to make a point and a half? Do you see anything? Do you see any movement? Are you hearing anything there in the trenches in terms of LO comp changing?
I mean, this has been thought of for years when we go through a cycle that's going to happen, and it has not happened in terms of that. I think that as long as the loan officer is the source of business from the realtor and they own that source, their value will continue to be supreme in the marketplace to other costs. So I don't necessarily see that happening. And I think that, it's hard because some of the bigger organizations are out trying to recruit today, and are, cutting their margins, and some have even, borrowed against the value of their actual institution in order to gain market share during this downturn, because they're larger and have more resources. So I don't necessarily see that, to be honest with you. I've heard this. I've been in the mortgage business for a long time, and I've seen this in a lot of downturns. It's like they're going to have to cut comp on LOs, but they're the source of the business. When that change, right?
Nobody wants to be the first penguin in the water.
Yeah, right.
When it comes to cutting LO comp, given the recruiting issues that are out there and signing bonuses that are still present. I think along those lines, since I brought it up, the signing bonuses that were paid a year ago or 2 years ago, I think it'll be interesting to see what happens to those loan officers who receive that money, who have seen their volume drop just like everybody else's, and whoever the actuarials are who calculated the signing bonus, hundreds of thousands, if not more, for some of these originators, and they're not hitting their targets. That's going to start popping up here, I would think, soon as we head toward the end of the year and into 2023.
I would agree with that totally. Those could be interesting discussions.
You're saying the guaranteed rate guy's got some buyer's remorse now, Rob, for the hundreds of millions he shelled out?
I don't know, but I've been formulating. There's a rumor at the house that Myrtle, my cat, has been offered a signing bonus from the neighbor for her mousing abilities. I'm fleshing out that story. I'll probably put it in the commentary Monday or Tuesday.
It's a free market, Rob. It's
right. All the line caught salmon she can eat.
It's a free.
Speaking of free, I mean, you could see. I think you're going to see LO comp almost kind of like naturally reprice itself a little bit. I mean, think about it. We're almost 7% on a 30-year fixed rate right now, and I mean, if the rates stay in this realm for a while, I mean, ARM's viability just in the past 7 days has gone up by some not insignificant percent. There still is, and I don't think will be at any time soon, any kind of secondary market for ARMs for all the reasons we've beat to death badly. So I don't, so you could see more LOs maybe transition to companies that can put loans in the portfolio, that can write, depository loans, and others that can do that. And we know those lenders pay a little bit less commission. I remember recruiting in a type of climate like this for a bank, and we were very effectively able to do that, by talking with LOs about being able to do, 8 loans a month instead of 5, because you could do construction, you can do ARMs, you could do non-warrantable condos, you could do doctor loans, you could do all the stuff that is kind of on the margin. So we'll see how that all evolves.
Well, it's interesting. Jeff was talking about the low cost. I've maintained for many years that in general, everyone is selling their products at the same level. The mortgage-backed security market, you can see it on the screen. That's the price. It's not like a big wholesaler might be getting a different price on their Ginnie Mae security than, somebody much smaller. But so what it comes down to is, well, how they value servicing, certainly, but the cost structure. And that's where a lot of banks and credit unions have picked up some market share because generally speaking, and Jeff, you probably know the numbers better than I do, but generally speaking, credit unions and banks don't pay their loan officers anywhere near what independent mortgage banks pay their loan officers. So they've got a little bit of a leg up there, I would think, and probably will continue to do that going forward.
Yeah, I mean that's an advantage they do have. They have an advantage on cost of funds, but they've had traditionally a disadvantage when it comes to infrastructure and infrastructure cost. They've been probably higher regulated, and they just have higher overhead that's assigned to them from the banking side than an independent mortgage banker has. Because I know that because I've worked for several banks in mortgage banking, and they always give you your overhead from the bank, and it's like, that's not my cost structure. But that's the case. They do have a higher cost structure, whether that's internally or perceived or not. It's the case, and they're cutting costs as well.
Yeah, I think so. When you talk about the interest rate climate and watching the Fed's moves, it's not like the warehouse costs are going down for independent mortgage banks. They continue to go up, and that tends to squeeze margins pretty heavily as well.
Yeah, and I think you also look at it and you go, okay, the second part of this cycle is as your net worth decreases, then you have your warehouse lines in jeopardy, and we go through that next cycle, which is coming, which is it's going to be a tough 6 months here, but I think this industry has proved itself very resilient in the past, and I think that there's going to be winners and losers, but there's going to be a lot of winners, and everybody's going to hang tough and get through it.
This is The Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman, and this week, special co-host, the CEO of InGenius, Jeff Walton. Fellas, I want to dig a little bit deeper on this whole, too big to fail, monopolistic tenants to the mortgage industry. Because Rob, you make a good point. There have been many instances in the past, Countrywide, Wells Fargo, others that have had dominant market share in the mortgage industry. We don't have that now. If you look at 2021, the top market share originator was Rocket, 8.8%, nowhere near what we saw from some of the biggest over time. But the percentage that the top 25 are doing, top 25 lenders are doing, again, is up 11% over the course of the last 3 years. And I would argue some things are different since the last time we've had this type of climate with the big lenders doing this high a percentage of the mortgage. Number one, the GSEs are under conservatorship and kind of have this mission statement to make housing finance equal to lenders across America. And there's credit quality is very good right now. And you also, again, I continue to hearken back to what matters most, that mortgage customers at a time where housing affordability is the worst it's ever been, stand to benefit in the mortgage industry from choice and smaller providers. Yet, it has this feeling to them, like the deck is somewhat stacked a little bit. Do you think, as we go into an election season, housing touches you think this is going to come up at all, or am I just nuts, Rob?
So first of all, congratulations, Rich. I don't remember the last time I heard somebody say "harken back" and use that well in a sentence. So hats off to you on that.
You used the word. It inspired me. I hadn't heard that word in a while. Yeah.
What were we talking about? No. So coincidentally, or maybe not coincidentally, Sunday afternoon, I help out on a panel at TMC regarding the midterm elections, and those midterm elections, the impacts on vendors and lenders, I think could be interesting, or it will be interesting. I just don't think that housing finance reform is high on anyone in Congress's list of things to do. And it's almost as if if the system's not broken, there's no need to fix it. And people are continuing to finance their homes. There's a secondary market for those loans. And it's not like you mentioned yourself, credit quality is good. You know, the ability to repay is in place. I think a lot of lenders, most lenders, I like to think, are minding their P's and Q's in terms of regulations and LO comp and so forth. So I think the atmosphere, certainly that we saw 14 years ago, that's definitely not the case now. And there are other things that the US government, I think, can focus on that are probably more important to the nation, rather than tweaking Fannie Mae or Freddie Mac, or you know, trying to explain to some 88-year-old senator what a private label security is. I just don't think that some much change is afoot. Now that may be different at the state level. I'm on the board of the California MBA, and there are always bills being, you know, brought up and issues being raised about finance and so forth. But it tends to be more tweaking than, you know, some broad gesture. Because, like I said, the system really isn't broken. If you need a home loan, you can go get a home loan. You might not like the interest rates, but the whole industry is dealing with the interest rates, and the whole finance system is dealing with interest rates. So it's not so much mortgage related. So I don't see that as a huge hot button. That said, I know that on Sunday we're going to be talking about how the House might go, or the Senate might go, in terms of Republican versus Democrat versus Libertarian or independents and so forth, and what impact that may have, not only to some extent on housing, but on the regulatory environment, because we still have that going on out there. I don't know. What, Rich,
are you saying? I'm not saying housing finance reform, but again, like we know CFP or FHFA is getting close to tweaking the loan level price adjustments. The broker, you know, Matt Ishbia, and would argue that the 0.25% broker fee the agencies charge on brokered loans would already be what I'm kind of talking about. Their way of regulating a little bit, with short of reform through delivery fees, could maybe see something there. Just speculating, but we'll see.
Maybe. I keep waiting for them to pull back the here, let's dust this off the Wayback Machine. Remember when I think it was a 10 basis point bump to the G fee to pay for some short-term transportation bill tax, something or other. Remember that when that happened?
That was the beginning of the end for G fees. That was when we lost control of G fee, and the ability to negotiate it.
That's still in place. Nobody talks about that. I think once the government latches on to whether it's a toll road or a toll on a bridge or some source of income in some governmental agency or some pseudo governmental agency, I think prying that out of a government's hands is next to impossible.
Rob, I think that sums it up the best. I mean, how would you predict the future of what they're going to do with the GSEs? And it's like they're making billions of dollars off of it.
Really hard.
Anybody who's going to give that up, I mean, just human nature by itself, let alone bureaucracies, I just don't see them giving that money up. And it's not broken to the point of where, you know, you got to fix it. I just don't see it happening. There's just not a impetus to lift that.
Yeah, Rich has been under contract by a hair care company for years now, and he doesn't want to see that income go away, no matter how short his hair is. So same thing. Rich.
I guess a full head of hair, intentionally short, by far the most follically gifted on this show. But
with that, oh boy, the time has flown.
Well, sorry you have to leave, Rich. I'm gonna miss you.
Jeff, talking about data and reading through CFPB's latest release that we've been talking about, again in there, the breadcrumbs, they mentioned that there were 5,500 mortgage lenders in America that originated a loan in 2019, only 4,300 last year, so 1,200 less companies originated a loan in 21, biggest year ever for the industry, versus 19. So, you know, when they say things like that, it's not without merit, in my opinion, or without basis. But Also in there, obviously a lot of statistics on minority lending. And that's really been what the IMBs are like, listen, hey, how can you, some of the regulatory restrictions they face and some of the proposed ones. And when people, I'm not bitching about market share, but when you hear people complain about the big lenders and the big IMBs, what they'll tell you is, listen, we're doing, and it was proven in the stats, IMBs, the national average on minority lending, 25% of all units, IMBs 27%. But if small IMBs had not faced really to this point a lot of regulatory pressure, you're starting to see the tea leaves change there as well. And again, all you got to do is read the CFPB releases. They, from this perspective, don't care about size, and they have a lot of data to look at to assess the lending landscape and lenders.
There's also some state regulations. I think I heard the other day there's 7 different states that have passed legislation or about to. Obviously, California, Illinois, and New York are ones. But one of the things that's coming up that I found very interesting was that depositories, in particular, on Community Reinvestment Act, used to go out at the end of quarter years and they would buy loans in low to moderate income zip codes and census tracts. And the regulators are not saying you can't buy loans in the secondary market in those census tracts. What they're saying is you can't swap them. Mm-hmm. So if they look a level below that and they see that you're doing well in certain zip codes for low to moderate income, and you're selling those to people that aren't doing well in yours that you are, and you're buying from them or others, where you're not, that is not solving an issue that was
clever though. Hats off to them.
Yeah, it's like financial engineering, right? As we hear, but they're going to look at that and say you can't do that, and that there's a systemic problem that's not getting solved when you do that, and so now you're going to have to actually address the problem. And I think that's a good thing in my mind. It's like either solve the problem or get rid of the regulation, but playing the games is not happening to solve anything systemically. So
that change is like long overdue. I remember back for many years selling CRA loans to banks that had to buy them to be in compliance. They'd buy them for me for like 103 and then write them down on their books for like 95 or 96 and take like a 7-8 point loss just to comply with regulation. But as I was selling the loans, I was happy to be making 103. But at the same time, I'm thinking, this is so stupid. Why do you even have this law if ABC Bank and wherever can do no lending in the communities they serve and just buy the loans from me and my bank's customers? So
yeah, I think that's right. And I think what you will see in that aspect is I think you will see, and in talking to various heads of large banks that are in charge of diverse markets, they're now talking about literally hiring loan officers and training them and putting them in markets that are going to solve that problem instead of just doing the purchase of loans. And so I think that's positive, so you're going to hire people that are trained on that and go back to increasing the pipelines and the manufacturing of those loans to LMI zip codes. I think that's a good thing to do. And then we'll sell you the data on those people so you can hire them away from the banks. And it just goes around, but we're going to add more people, and we're going to solve a systemic problem and not do the, financial engineering. I think that's important.
Absolutely. And as always, a lot of good stuff coming in the chat. Long show regular, Bob Niemi, a really strong compliance background in our industry. Notes Massachusetts, New York, and Illinois have state CRA regulations for IMBs. California's bill is moving to a study bill to determine if necessary. Expect more to come. I would agree with that. And, this is not like we're trying to scare you. What we are trying to do through this show is educate and inform and be real and tell people what we're hearing and seeing in the marketplace so they can make better decisions and get some perspective outside their silos. This show has been, there's not been a lot of exciting, positive stuff to talk about this year. So we talk about what's relevant to mortgage lenders, and that is certainly a relevant issue right now, Jeff. But companies like InGenius make it a lot easier. I cannot tell you the crap and the hoops I used to jump through to ensure compliance and regulation in my banking days with fair lending and CRA, homemade spreadsheets and cobbled together reports from crappy systems. So it's easier now for mortgage lenders that are aware of the importance to comply.
Absolutely.
Well, we're just about out of time for the week. Bob wants Ohio State football. Our board of directors dinner Saturday night coincides exactly with Ohio State, Wisconsin. That's a sore subject with me right now, but Brownies look good last night, and football season certainly off and running. Fall is in the air. I don't know what you guys are. Jeff, you live in Arizona, right?
Yeah, so it broke 100. We started, chopping firewood for when it gets into the 60s, because we will burn a fire in Arizona when it gets in the 60s. That does happen, but it's starting to cool off, definitely. Although it's 80 degrees in San Diego today.
We got 40 and leaves and gray skies in Cleveland, so it's fall is here. But well, I know everybody's weekend plans. I'll see you guys all this weekend. Jumping on a flight tomorrow morning, heading out to Chicago for TMC in Chi-Town. Really looking forward to seeing everybody and getting the chance to interact with the members. It's what we do is more important now than ever. You're seeing that with the attendance of the conference, and looking forward to seeing everybody this weekend. So,
Rich, do you still want me to pick you up in my rented Toyota Corolla, or are you going to take an Uber in?
I think, I think I'll just Uber in, but thank you.
Okay, let me know. I'm a good backup.
All right. And anything else you guys have for the audience before we take it into the weekend?
See you in Chicago, but not that part of Chicago, Rob.
Yeah, I would recommend to Rich's point about the weather. Check the weather. I don't think it's supposed to rain the next several days, but it's the temperatures definitely come down.
Yeah.
Good stuff. Excellent. And Tom Gallucci, how could I omit my Cleveland Guardians, the youngest team in baseball, second best minor league system, and they're going to be the youngest team to ever win a division in the modern era. So good stuff there. I had to throw that in. But I will see many of you in Chicago this weekend. Thank you, Jeff. Thank you, InGenius. Anybody info on InGenius, it's in the chat, or anybody on our team. And he'll obviously be in Chicago all weekend. So, all right, guys, take care. See you this weekend.
Bye.